A stock market crash is coming. You've seen the headlines. Your favorite finance YouTubers are sounding alarms, red arrows everywhere. It's scary, but what if I told you this could be the moment that changes your life financially forever? Yes, crashes can destroy wealth, but they also transfer it from those who panic to those who prepare. This video isn't about fear, it's about strategy, the kind that helped Warren Buffett make billions when the world was losing its mind. The kind that helped regular investors double their money after the COVID crash while others ran for the exits. You clicked because you saw crash coming. Now I'm telling you that panic is not your plan. Your plan is profit smart, calm, strategic profit. But how? And more importantly, what should you not do when the market tanks? Stick around because I'm going to walk you through 15 powerful strategies. From bulletproof portfolio setups to mindset shifts and real stories of people who made millions while others lost everything. This isn't just survival. This is how you win the crash. Market crashes aren't random events. They follow patterns as predictable as weather systems. Yet most investors only see these patterns in hindsight when their portfolios have already taken a severe hit. The seeds of a crash are planted during excessive optimism. Stock prices climb far above what business performance justifies. Companies with mediocre earnings command sky-high valuations because everyone believes prices will keep rising. This disconnect between price and value is the first warning sign. Months before the crash, 3 critical signals appear. Margin trading increases, retail investors jump in driven by FOMO, and media publishes stories about new economic paradigms. To spot these warnings early, watch 3 metrics: price-to-earnings ratios above historical averages, like the 2000 dot-com bubble's 40+ PE ratios, sentiment indexes showing extreme bullishness, and unusual spikes in trading volume. Understanding these patterns helps you prepare your portfolio for inevitable turbulence, protecting wealth while others remain oblivious. Market bubbles are incredibly predictable, yet most investors get caught in them anyway. These dangerous financial phenomena form when excitement about a new technology or trend pushes stock prices way beyond what companies are actually worth. Every bubble follows the same 5-stage pattern. First comes displacement. A new technology like the internet emerges. Then the boom begins as early investors see prices rising. Next is euphoria, where rational thinking disappears. That's followed by smart money quietly taking profits. Finally, panic selling occurs. Bubbles are like overinflated balloons stretching until they inevitably pop. Consider the 1990s dot-com crash, when companies with .com in their name saw valuations surge despite having no viable business model. Warning signs include unprofitable companies receiving billion-dollar valuations, regular people quitting jobs to day trade, and media celebrating overnight investor successes. Recognizing these patterns early gives you time to protect your portfolio before the inevitable collapse happens. Many investors make a critical mistake. They think stock market crashes and economic recessions are the same thing. They're not. Sometimes markets crash without a recession following, like the 1987 Black Monday crash, while the 1990 recession saw relatively minor market declines. Understanding this distinction gives you a serious advantage. The stock market acts as an early warning system, typically declining 6 to 9 months before a recession is officially declared. Investors price in their expectations about future business conditions well in advance. 3 economic indicators serve as reliable recession warning flags: yield curve inversions, when short-term rates exceed long-term rates, rising unemployment claims, and declining consumer confidence. The 2001 recession demonstrates this perfectly. By the time economists announced it, markets had already fallen 30% from their highs, while most people were selling near the bottom. Prepared investors had already positioned themselves to protect capital and find bargains when others panicked. Some market disasters can't be predicted no matter how closely you watch the charts. These are black swan events, the sudden shocks that send markets into freefall. From the September 11th attacks to the COVID-19 pandemic, these unexpected crises have triggered some of history's most severe market crashes. Like electrical storms appearing in clear skies, these events create profound uncertainty about the future. During the COVID crash in 2020, markets plummeted 34% in just 23 trading days, the fastest bear market in history, not because the economy had collapsed, but because future outcomes became unknowable. Black swan events follow predictable market patterns: shock selling, extreme volatility, liquidity squeezes, and eventual recovery. Success comes from preparation, not prediction. Building resilience through diversification across asset classes, Maintaining adequate cash reserves and psychological readiness for turbulence are crucial. The investors who thrive aren't fortune tellers. They're architects of all-weather portfolios designed to withstand any storm. When markets crash, something happens in our brains that transforms even the most logical investors into panicked sellers. That primitive part of your brain, the amygdala, kicks into high gear, triggering the same fight-or-flight response you'd have facing a predator in the wild. Neuroscience explains why this happens. Financial losses activate the same brain regions as physical pain. Watching your portfolio drop 30% registers in your brain similarly to burning your hand on a hot stove. Like a throbbing injury demanding immediate attention, your brain screams for relief from financial pain. This relates to loss aversion. We feel losses 2 to 3 times more intensely than equivalent gains. A $10,000 loss hurts far more than a $10,000 gain feels good. Take John, a seasoned investor who abandoned his strategy during 2008, selling everything at the bottom. "I couldn't sleep. I just needed the bleeding to stop," he later admitted. He missed the recovery, costing him 40% of his retirement savings. Successful investors aren't necessarily smarter. They've created systems protecting themselves from their psychology. The dot-com bubble showcased investor madness like nothing before it. From 1995 to 2000, the Nasdaq rose an incredible 400%, only to come crashing down and lose 78% of its value. The recovery took 15 years. An entire generation of investment returns wiped out. The bubble was extraordinary. Companies with zero profits and barely any revenue were valued in the billions. Pets.com raised $82 million in their IPO despite losing money on every single pet product they sold. Warning signs were everywhere. Tech stocks traded at average PE ratios above 200. Companies with no clear business model spent millions on Super Bowl commercials. The collapse in March 2000 happened gradually. Investors slowly realized that companies needed actual profits, not just website visitors. Those who stuck with fundamentals preserved their capital. The crash created buying opportunities. Amazon fell from $107 to $5.97 per share. Investors who recognized Amazon's potential amid the panic made one of history's greatest stock market investments. The 2008 financial crisis wasn't just another market dip. It wiped out $8 trillion in U.S. stock market value, sending the S&P 500 plummeting 57% from its peak, the worst decline since the Great Depression. This wasn't your typical crash. What made 2008 uniquely terrifying was how it threatened the entire financial system. We watched Lehman Brothers, a 158-year-old institution, collapse completely. Other major banks were days away from the same fate. The crisis revealed how dangerously interconnected global finance had become. Problems with U.S. subprime mortgages spread through complex derivatives, nearly toppling banks worldwide. While most investors panicked and sold, Warren Buffett did the opposite. He published his famous "Buy American I Am" op-ed in October 2008, expressing his confidence in America's economic future. He invested billions when fear was at its highest. Investors who stayed the course saw portfolios recover by 2013. The crash created incredible opportunities. Bank of America dropped to $2.53 before climbing above $40, rewarding those brave enough to buy. The COVID-19 crash rewrote the rules of market downturns. Unlike previous crashes that developed gradually, this one hit like lightning. The S&P 500 plummeted 34% in just 23 trading days as the world shut down almost overnight. Investors barely had time to process what was happening before markets reached bottom. The aftermath was extraordinary. The shortest bear market in history. Just 33 days after hitting rock bottom, a new bull market began. This caught countless investors flat-footed, especially those who panic sold near the lows. The market response varied dramatically by sector. Airlines and cruise lines collapsed as travel halted. Technology stocks quickly recovered as remote work surged. Zoom saw its stock rise 400%, while Amazon gained 70%. Even home improvement retailers like Home Depot outperformed as consumers redirected spending. The Federal Reserve's intervention drove this rapid recovery. They slashed interest rates to zero and purchased trillions in assets. Investors who recognized this crisis's unique nature saw extraordinary returns, doubling or tripling investments in quality tech companies within a year. Warren Buffett has mastered the art of market crashes like no one else in investment history. His approach comes down to one simple principle: be fearful when others are greedy, and greedy when others are fearful. But what does this actually mean in practice? During the 2008 crisis, while most investors ran for safety, Buffett invested $5 billion in Goldman Sachs and $3 billion in General Electric when both giants appeared vulnerable. These bold moves generated billions in profits. His crash preparation begins years before markets turn south. By building massive cash reserves during good times, sometimes holding $100 billion plus while critics call him too conservative, Buffett creates the firepower needed when opportunities arise. This patient strategy enables his selective approach during downturns. He targets companies with strong balance sheets capable of weathering extended crisis. The 1973-74 crash, 1987 crash, and 2008 financial crisis produced some of Buffett's biggest winners. His success comes from having both financial and psychological preparation to act when others freeze in fear. A crash-resistant portfolio isn't about avoiding all losses. That's impossible. It's about building something strong enough that you won't be forced to sell at the worst possible moment. Think of it as constructing a financial house with sturdy foundations, load-bearing walls, and reinforced supports. The foundation is proper asset allocation, finding the right mix of stocks, bonds, cash, and alternative investments based on your timeline and risk tolerance. During the 2000 dot-com crash, an investor with 100% tech stocks lost 78%, while one with a balanced portfolio including consumer staples and utilities preserved capital and recovered quickly. Quality investments with strong balance sheets, low debt, and steady cash flows typically weather downturns better and recover faster. Maintaining cash reserves of 10 to 20% provides psychological comfort during market turmoil and buying power for discounted assets. The best crash-resistant portfolios keep you calm and rational when everyone else is panicking. Dollar-cost averaging transforms market crashes from something to fear into real opportunities. While everyone else sees disaster, you'll be quietly building wealth with this simple strategy. The concept is straightforward. Invest a fixed amount at regular intervals regardless of market conditions. During the 2008 crash, investors who steadily put $500 monthly into S&P 500 index funds accumulated twice as many shares at lower prices. Like filling a reservoir one bucket at a time, these extra shares created substantial returns when markets recovered. DCA provides psychological relief by replacing one stressful decision with many small, consistent ones. This removes the pressure of timing the market perfectly. Research confirms that while lump sum investing works better in steadily rising markets about 66% of the time, DCA significantly outperforms during major downturns. The behavioral benefits create a system that prevents emotional decisions during market turmoil. Investors who maintained their DCA approach through the dot-com crash, 2008 crisis, and COVID-19 crash achieved far better results than those who panicked. Market crashes create rare opportunities to buy high-quality companies at discount prices. The challenge is determining whether a stock has fallen because of temporary market panic or because of real damage to the business itself. 5 indicators help identify genuine quality stocks during downturns. Consistent cash flow generation. Apple maintained positive cash flow through the 2008 crisis. Low debt-to-equity ratios. Amazon's minimal debt positioned it for a strong recovery post-2000 crash. Sustainable competitive advantages. Coca-Cola's brand moat protected margins during the 1987 crash. Management team track record. Berkshire Hathaway's experienced leadership guided it through multiple downturns. History of weathering previous crashes. Johnson & Johnson rebounded quickly after the 2000 dot-com bubble. During the 2020 COVID crash, Disney fell 40% despite having financial strength to survive park closures, while Disney Plus thrived during lockdowns. Valuation metrics become revealing during crashes. Companies trading below book value or at single-digit PE ratios often represent extraordinary opportunities if their business remains sound. When markets crash, not all sectors get hit equally, and these differences create strategic opportunities for smart investors. You can actually reposition your portfolio both for protection during the crash and for maximum gains during recovery. The dot-com collapse of 2000 to 2002 illustrates this perfectly. While tech stocks plummeted 78%, utilities gained 11% and consumer staples remained stable, like a landscape where some areas face violent storms while others enjoy calm weather. Market sectors respond differently to economic turbulence. Market crashes follow predictable rotation patterns. Consumer discretionary and technology stocks typically fall first because consumer spending dries up. Meanwhile, utilities, healthcare, and consumer staples show resilience as people need these services regardless of economic conditions. During recovery, financial and consumer discretionary stocks lead the initial rebound, followed by industrials and technology. The COVID-19 crash broke many historical patterns, with technology leading both decline and recovery. Successful sector rotation requires gradually shifting allocations as evidence of changing economic conditions emerges. What separates millionaires from average investors during market crashes? It's not access to better information or sophisticated trading strategies. It's their mindset. The greatest investors in history share one fundamental trait. They see market crashes as rare wealth-building opportunities that only come a few times each decade. Consider Warren Buffett, who invested $5 billion in Goldman Sachs during the 2008 crash, later earning billions when markets recovered. Like a seasoned captain navigating stormy seas while others abandon ship, millionaires maintain emotional discipline when everyone else panics. The S&P 500 has experienced 26 bear markets since 1928, yet has returned an average of 10% annually long-term. On any chart, even the 2008 crisis appears as a small dip in an upward trajectory. Successful investors prepare mentally before crashes happen, deciding their response strategies in advance. Millionaires acknowledge fear while preventing it from controlling their decisions. They feel the same anxiety as everyone else. They've just trained themselves to act despite it. Market crashes might seem like financial disasters, but they're actually predictable parts of market cycles that create wealth-building opportunities for prepared investors. Data consistently shows that those who bought stocks during the 5 worst market crashes of the past century and held for 10+ years actually outperformed those who invested during stable periods. The mathematics of recovery creates extraordinary opportunities. When a market falls 50%, it must gain 100% just to break even. Investors who enter early in recovery position themselves to double their money as markets return to previous levels. Compounding returns work with remarkable power after crashes. The bull market following 2009 created more millionaires than any previous period, starting from such a low base. Investors who bought when the S&P 500 had fallen 57% saw a full recovery by 2013. Building significant wealth requires enduring multiple market cycles. Most millionaire investors have weathered 3 to 5 major downturns while maintaining discipline. A $1 investment in U.S. stocks in 1871 would have grown to $31,255 by 2025, despite 19 crashes. The ultimate wealth-building secret is embracing crashes as moments when life-changing returns become possible. Bank of America fell to $2.53 in 2008 before recovering to over $40 a decade later. A 1,500% return for those who recognized value amid panic. Market crashes aren't disasters. They're wealth transfer mechanisms. Money moves from emotional investors to disciplined ones, from those caught off guard to those who prepared in advance. Throughout history, this pattern has repeated with remarkable consistency. The investors who build lasting wealth aren't those who avoid crashes. They're the ones who position themselves to benefit when crashes inevitably occur. We've covered essential aspects of market downturns, their predictable patterns, bubble formations, economic relationships, and unpredictable black swan events. We've examined the psychology driving panic selling and how our brains process financial losses as physical pain. Through studying major crashes like the dot-com collapse, the 2008 financial crisis, and the COVID-19 crash, we've uncovered opportunities that appeared during each. Our practical strategies include building crash-resistant portfolios, dollar-cost averaging through downturns, identifying quality stocks at discount prices, and rotating between sectors strategically. The difference between average investors and wealth builders comes down to mindset. Average investors fear crashes. Successful investors prepare for them, viewing downturns as fertile soil where wealth can grow most abundantly. Like farmers who know spring follows winter, they plant seeds during market winters, knowing the eventual harvest will be substantial. Every market crash in history has eventually recovered and reached new highs. Markets have endured world wars, the Great Depression, stagflation, terrorist attacks, and global pandemics, yet still trend upward over time. The question isn't whether another crash is coming, it's whether you'll be positioned to benefit when it happens. Will you join those who transfer wealth to themselves during these critical moments? Or will you be on the other side of that transfer? When the next market winter arrives, will you see barren landscape or fertile ground? The choice is yours, and the time to prepare is now. You started this video maybe feeling worried, maybe overwhelmed, maybe afraid. Now you know better. Crashes are not the end. They are not your enemy. They are your opportunity. But opportunity is worthless without action. You've just learned how the world's greatest investors think during chaos, how they plan, act, and stay calm when everyone else is losing it. The question is, will you? Will you keep checking the news and panicking, or will you start building that resilient portfolio? Automate your investing. Spot bargains when others are blind. You've seen how people got rich in every crash quietly, patiently, while the world screamed. Now it's your turn. If you got value from this, smash that like button so more smart investors see it. Hit subscribe if you want to be the calm in the chaos, and drop a comment. What will your strategy be when the market falls? This isn't a channel for panic. It's a channel for power. Thanks for watching. Let's get ready, not scared.